Hello and welcome back to If You Don't Have Time to Do Anything Else, Just Do These 10 Things and You Will Achieve Financial Independence in the Military. I'm Spencer, militarymoneymanual.com, and we're going to quickly recap the first 6 steps and then we'll get into step 7. So step number 1, start a monthly 5% contribution of your military base pay to your Roth thrift savings plan.
Step number 2, create a TSP account and ensure you are invested in the latest L fund closest to your retirement date.
Number 3, save at least $1,000 for an emergency fund. With a recent government shutdown, this has become even more important.
Yep. Number 4, budget a realistic amount for rent, food, transportation, and other expenses.
Number 5, pay your high interest rate debts down.
Number 6, based on your budget, increase your emergency fund to cover 3 months of expenses.
Okay, now we're getting into the fun stuff, actually investing. So step number 7, open a Vanguard Roth individual retirement account, IRA, and contribute the maximum annual limit, which this year is $7,000. Next year it's going to change, so make sure you check in the future, to a total stock market index fund. For example, you could use VTI, the Vanguard Total Stock Market Index Fund, SCHB, that's Schwab's Total Stock Market Index Fund, or FZROX, the Fidelity Total Stock Market Index Fund. Any of those would be good. And I said open up a Vanguard IRA, Roth IRA. Jamie, you could open up a Schwab, a Fidelity. You can open up a Roth IRA just about anywhere, but usually I like to recommend people stick to kind of those 3 big investment houses because they just seem to work and it's just silly to go anywhere else.
And Spencer, the big picture of why you recommend and why we talk about total stock market index type funds investing is because we're going to buy a little bit of a company, all 3,800 or so companies that are publicly traded in the US. So instead of trying to identify the next Nvidia or the next Apple or the next, I don't know, Raising Cane's if they're even public, I don't know, but whatever's going to be hot next month, you just buy a little bit of everything. And over time, the US stock market tends to, and historically has gone up and to the right. And there's months where it goes up, months where it goes down, but the overall trend is up and to the right. So when you buy a little bit of everything, you take average returns and you don't take the risk of going to nothing because you picked the wrong hot stock tip.
Jamie, I like to talk about my low-cost, automated, diversified, and simple investment strategy, or the LADS method. The core of it is buying low-cost index funds, and you just explained it so well there, but I mean, the reason is low cost because if you look at what actually affects your investment performance, fees, the fees that you pay, people ignore these for years and years and decades, and they eat away at your investment returns. There's a company out there that's very popular with military service members that will recommend that you go into these funds that have very high load fees. So they're taking money when you invest, and they're taking money every year out of your returns. And it's just not very well understood. Whereas if you go to one of these low-cost providers like Vanguard, Fidelity, Schwab, you're paying like 3 cents a year for every $100 you have invested. They're very, very low cost, which means that you get to keep more of the returns. They're also automated and diversified. Like you said, Jamie, over 3,000 companies in each of these funds. These funds are not going to zero. There's just no chance that these funds are going to be worth nothing one day. They are constantly evolving, constantly adding companies that fall out of the index because they no longer exist, just poof, kind of disappear. And companies that grow and become bigger parts of the US stock market naturally grow and become bigger parts of your portfolio. So if you had bought a low-cost, automated, diversified, simple index fund 10 years ago, you would have bought a little bit of Nvidia. Today, if you buy into that fund, you're buying a lot of Nvidia because it makes up a big chunk of the fund. But the point is that when you were investing 10 years ago, you were buying this little hardware, this little graphics company that no one really had ever heard of. And you got to enjoy its massive growth over the last 10 years. You didn't have to pick any stocks. You just got to buy the entire haystack. You didn't have to look for the needle in it.
And you mentioned other options, VTI being one of them. A mutual fund like VTSAX or ETF, an exchange traded fund like VTI, are basically the same thing. Their fee structure is the same. Their composition's the same. And so it's just a matter of, do you want the price at the end of the day? Do you want to be able to trade at the end of the day with yesterday's price with a VTSAX like mutual fund, or do you want instant trading with an ETF and instant changes to the price?
Yeah, and I've gone back and forth on this, Jamie. I mean, if people really want to deep dive into it, go to the Bogleheads forum and they can spend hours reading about the difference between a mutual fund and an ETF. And for the average military investor, there's zero difference. It does not matter. The important thing is to not have paralysis by analysis and to actually do something, as you like to say, Jamie, and to take action and to start investing in your future. And you can do that through the Roth TSP. You can also do that through a Roth IRA.
So you just mentioned the TSP. This one specifically, step 7, is about an individual retirement arrangement or account. How is that different from what we do in the TSP when we talk about maybe buying the C and the S fund in the TSP to kind of get a similar mix of all the US stock market?
It's actually very similar. So the C fund is your S&P 500. The S fund is the rest of the US stock market. If you put them together, you have 80% C fund, 20% S fund. You've just recreated a total US stock market. Now, if you're in the TSP, Roth TSP, and you're investing in a life cycle fund like we've recommended, then you have a total US stock market index fund in there, and you also have a total international stock market index fund in there. As you continue to invest and as your TSP continues to grow over the years, slowly they're going to add a total US government bond fund and a total US corporate bond fund to the mix as well, just to kind of smooth out the ride a little bit and have some less volatility in your thrift savings plan account. So this is an additional account to the TSP. You could skip the Roth IRA. You could just invest into your Roth TSP. But I encourage people to also invest into their Roth TSP and into their Roth IRA. And this is the other point of confusion, Jamie, is a lot of people hear Roth, and they think it's the same thing and the contribution limits are the same and I can only put $7,000 into my Roth TSP. No. Please, I wish somebody would rebrand these things, but a Roth TSP has a much higher contribution limit than a Roth IRA. It changes every year. I hesitate to even mention what the contribution limits are because they're going to be out of date in just 2 months here. But look it up, tsp.gov, look at the contribution limits. If you're just joining the military or you are just starting to invest, you're probably going to be shocked at how high the contribution limits are to your Roth TSP. They're going to be well over $20,000. And a Roth IRA is probably still a few years, if not decades away from being a $10,000 limit. And the time of this recording, it's a $7,000 limit. So, but again, it changes. I know it changes every year. So just Google it. This is your homework assignment. Google. If you listen to this podcast in the future, just Google or search, because maybe Google won't even exist, but search Roth IRA contribution limit and it'll tell you.
And I know back in week 1, we mentioned the Roth TSP. And I know this is a quick hit too, quick episode. Why are you saying Roth IRA for this individual retirement account versus the Roth in the employer-sponsored TSP?
For 99% of military service members, you have very low taxable pay, especially if you look at the whole pay package that you're getting. Like if you're receiving BAH, that is completely untaxed allowance. BAS is an untaxed allowance. If you do any time in a combat zone tax exclusion area, deployed area, CZTE, your income is not subject to federal income tax. So you have such low taxes, it would make sense to pay your taxes now and then in retirement, when hopefully your net worth has grown and your income has grown, you can withdraw that money tax-free. There are very, very small edge cases. Like if you are, let's say, a colonel doctor in the Army or the Air Force, Navy, Marines, and maybe then you should transition to putting money into your traditional retirement account. But I just looked the other day, Jamie, as an officer pilot, up until a 12-year major, my effective tax rate was well under 10%. In fact, most years it was under 5%. And that's a very high earning military officer. So for everybody who's enlisted, maybe start looking at contributing to your traditional accounts versus your Roth accounts about the 05 timeline, unless you're dual military. But even then, it's probably not worth it. So I'm very confident if you're listening to this podcast, you can contribute to your Roth and you'll be okay.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.